Hello, and thank you for joining us for this special edition of Take Stock. I'm Jennie Hudnall, Director of Marketing at Bridges Trust. And in these conversations, our goal is to take stock, to step back and share perspectives on what's shaping markets through a long-term lens. Today's discussion is especially timely following the Berkshire Hathaway Annual Meeting this past weekend right here in our own backyard in Omaha, Nebraska. But before we dive in with our guests, let's take care of the necessary disclosures. The views shared today reflect the perspectives of the Bridges Trust investment team as of the date of this recording. This discussion is for informational purposes only and should not be considered personalized investment advice. As always, please reach out to your Bridges Trust relationship manager for guidance specific to your situation. All right, now on to the good stuff. Today, I'm joined by two of my colleagues, Jack Holmes, our Chief Investment Officer, and Colter Boice, portfolio manager who spends a great deal of his time researching Berkshire and its underlying businesses. To kick things off, let's start out with you, Jack. If you had to summarize the meeting in one word, what would it be? And then unpack that for us.
Sure. Thanks, Jenny. I'd say transparency. This was a very unique meeting this year. Obviously, a seminal moment of the transition from Warren Buffett to Greg Abel as CEO. So it was a little bit lighter on the folksy wisdom of Warren Buffett and Charlie Munger, as we would expect, but it was heavier on, financial and operational detail. So for analysts like, Colter and myself, it was more insightful to the underlying business at Berkshire Hathaway.
Nice. Colter, how about you?
Yeah, I really, thought we gained an enhanced perspective of how Greg Abel really sees the business in this meeting, both in terms of capital deployment, how he's seeing opportunities in the current landscape and within their existing portfolio. Not surprisingly, there's a lot of consistency with how Warren and Charlie have historically evaluated opportunities. But we also got to go a layer deeper and really dive into how Greg is viewing the existing operating businesses and the KPIs and things that he's looking at within each of those business segments.
Nice. Jack, let's come back to you and talk a little bit about performance. Berkshire has underperformed the market meaningfully over the past year. From your perspective, what's been driving that?
I think there's a few factors there. So Berkshire, since last year's annual meeting, is down about 12%, and the S&P 500 is up close to 30. So that change is actually the biggest relative difference between meetings in the last 40 years. And I think it's partly what Berkshire owns and what they don't own. So in terms of what they don't own, they're lighter on technology stocks. Besides owning Apple, they're meaningfully underweight technology as a percentage of the business versus the market, and that's been driving a lot of the index gains over the past year. And then in terms of what they do own, the core of the business is insurance operations, and that business is entering a more difficult underwriting environment in the coming years. And I think the market's starting to price that in as reflected in other publicly traded insurance stocks. So those are the two bigger factors, I think, that have driven the relative performance gap over the past 12 months. And then I think the last thing would maybe be the Buffett premium valuation. It probably got a little bit ahead of itself going into last year's meeting. And, with some of the uncertainty around transition to Greg Abel, some of that Buffett premium maybe has come out of the stock over the past year.
Colter, one of the themes that keeps coming up is Berkshire's cash position. Berkshire continues to accumulate cash, which hit another record high for the first quarter. How should we be thinking about that?
Yeah, thanks, Jenny. One of the ways that we're really thinking about cash and looking at cash historically is as a percentage of assets. And so cash over time for Berkshire, if you go back over the last 20 to 25 years, has averaged about 15% of assets. Last year, we saw that number increase to about 30%, and this year it had increased a little bit more, and we ended Q1 at just over 30%. And so if Berkshire over time was simply to deploy the existing cash balance back down to long-term averages, they'd have to deploy about $190 billion. And so that is what we call excess cash on the balance sheet today. Our equity returns that we realize will ultimately be impacted by how Berkshire deploys that cash balance. And so that's something we're looking at them to do in the coming quarters, whether that be through share repurchases, buying public securities or buying private businesses. And that's going to take a significant amount of time to get deployed.
And maybe to round things out, Jack, let's come back to you. How do you think about valuation for Berkshire and what that could mean for expected returns of the business going forward?
So that was one of the insights that Greg Abel provided at the meeting this year, was more detail on how he determines intrinsic value. And that ultimately leads to their repurchase of share decision. So as Colter mentioned, it's one of the ways they can deploy capital in the coming years. They did a small amount in the first quarter, but as you can see, it's minimal as a relation to their overall cash pile and even what they've done in previous years. Price to book value is one measure of relative value for the business, and that's also illustrated on this chart here. And that's come down over the past year. Again, Berkshire's valuation had crept up going into last year's annual meeting. It's more reasonable today. But then obviously there's adjustments for the acquisitions they've done over time, and just the nature of the business today versus what it was 15, 20 years ago. So valuation is more reasonable today. I think the underlying performance of the business is going to determine the long-term returns, more so than where current valuations are. And as Colter mentioned, how they deploy that excess capital. I'm not sure we got all of our questions answered as it relates to Greg's focus on the public securities portfolio management going forward. That's sort of one of those questions that remain outstanding. And obviously they need to be able to put that capital to work at an above market rate for us to earn excess returns over time. Berkshire's historically done that, but there's a lot more questions today with new management and a growing cash pile that has us a little bit more uncertain. But I think, again, coming from last year to now, valuation looks more reasonable, which probably sets us up for, better returns here moving forward.
All right, gentlemen. Well, really appreciate both of your perspectives, and everyone listening, thank you for spending a few minutes with us. We always appreciate the time, and we look forward to continuing the conversation as we take stock. Until next time, take care.